Joining us today, we are here to present a comprehensive valuation analysis of North Star Casting Company. First, let's do introductions. My name is Brittany Witt. I'm with the University of Houston, getting my professional MBA, specializing in entrepreneurship and leadership.
Hi all, my name is Sherry Fan. I currently study Master in Finance at University of Houston.
Hi, my name is Pranav Sayani. I'm currently studying Master of Science in Finance in the University of Houston.
Hi everyone, my name is Mirza and I'm currently pursuing Masters in Finance at the University of Houston.
Hi everyone, my name is Jaimin Pandya and I'm also pursuing Master in Finance from University of Houston in the Wealth Management track.
Our objective today is to provide a fair and thorough evaluation to serve as a basis for determining the buy and sell price for employees involved in the trust. To do so, we'll be considering key regulatory and professional standards as outlined in the ASA's guidelines. We've carefully reviewed internal and external factors, including market dynamics, competitive positioning, and operational risk to ensure our analysis aligns with recognized valuation methodologies. Throughout our presentation, we'll walk you through the steps we took, the rationale behind our approach, and the conclusion we reached to give a clear picture of the company's valuation. Our presentation topics today will be the company overview, economic and industry analysis, financial analysis, and valuation. The company. North Star was founded in 1918 and is one of the North America's oldest precision aluminum and magnesium die casting companies. They are headquartered in Chicago, Illinois, and 2 additional facilities in Indianapolis and Cleveland. They became 51% employee owned in 2021 through an employee stock ownership plan. Established by Herschel Birnbaum in Chicago, North Star has been a pioneer in die casting for over a century. In 1974, ownership transitioned from the Birnbaum family to Jim Hardman and then to his sons in 1979. Since 2021, North Star has operated under employee ownership with Greg Smith as CEO and George Hardman as chairman. North Star provides design modification, tooling, die casting, machining, and post-production assembly services. They specialize in precision aluminum and magnesium die casting and offer tailored solutions for automotive, medical, defense, HVAC, and aerospace sectors. They serve approximately 70 active customers across diverse industries and maintain an internal policy to limit automotive industry sales to below 50% and any single customer share to a maximum of 20%, managing their exposure to market cycles and customer concentration risk. North Star's extensive experience and reputation in magnesium casting sets it apart in the die casting industry. They compete with both large and small U.S. and international die casting companies and differentiate themselves through their product quality, technological advancements, and high standards. The Cleveland facility focuses exclusively on magnesium, a distinctive capability that supports North Star's strategy to lead in lightweight materials. They have a strong leadership team with decades of experience, including their CEO, Greg Smith, and President Brian Anderson, both with extensive internal career paths. They have active succession planning, deep industry knowledge, and a culture of employee empowerment, while also reducing reliance on any single leader to support company stability. North Star is an Illinois corporation with 500,000 shares of common stock authorized. A 100-for-1 stock split occurred in 2023, with 435,000 shares currently outstanding. Ownership is distributed between the employee stock ownership plan and George Hardman, 51 to 49%. The company has elected to be taxed under Subchapter S. And in 2021, George Hardman sold a majority interest to the employee stock ownership plan as a strategic move to reinforce an employee-centered ownership structure. Prior to that structure, North Star's shares remain largely within the Hardman family with minimal transactions. With that, I'll pass it over to Sherry to provide further information about the economic and industry analysis.
So in 2024, global economic growth is forecast to be at 2.9%, a slight down from the review's 3%, and various challenges shaping the economic landscape, geopolitical risk, persistent inflation, and trade fragmentation are impacting the stabilities of supply chains worldwide. In the manufacturing sector, labor and wage pressure influence operation efficiency. In the US economy, although it's bolstered by consumer spending slowed down a little bit in the fourth quarter, though anticipated at 2%. Inflation currently at 2.3% remain a central factor in the Federal Reserve policy adjustment. Consequently, rising borrowing costs. For the casting industry, the economic factor have significant implication. Demand-sensitive sectors like automotive, aerospace, and medical device show a potential role. However, it still be constrained by tight labor markets and rising material costs. Despite the challenge, the die casting industry is projected as robust to 6.24% annually from 2024 to 2029, underscoring the industry resilience and capacity for adaptation.
The purpose of this valuation is to determine the fair market value of North Star shares for the ESOPs, ensuring that employees buy or sell shares at a fair price that reflects the company's economic value. The standard of value we've used is fair market value, which is defined as the price at which willing buyer and seller would agree, with full knowledge and no external pressures. This standard is appropriate for ESOP valuation as it aligns with regulation ensuring fair and equitable transactions for employees. As a closely held company, North Star shares are not publicly traded, limiting marketability. However, ESOP regulations provide employees with a put option to sell shares back to the company or ESOP at fair market value, offering liquidity. The fair market value definition in this appraisal adheres to IRS and Department of Labor guidelines, ensuring compliance with legal standards for the ESOP companies. For the financial analysis, income statement shows steady revenue growth from 2020, peaking at $50.19 million in 2023, before a 9.7% drop to $45.35 million in 2024. Despite this, the company improved its gross profit margin from 10.1% in 2021 to 13.9% in 2024. Operating income also rose significantly from 0.44 million in 2021 to 1.92 million in 2024, reflecting enhanced efficiency. North Star's balance sheet highlights consistent asset growth from 25.3 million in 2020 to 29.8 million in 2024, driven by investments in machinery. Liabilities rose to 21 million in 2022, then slightly declined to 20. The debt to equity ratio improved from 3.21 to 2.3 in 2024, showing North Star's commitment to reducing debt and boosting financial stability. Although cash flow data isn't available, North Star's other statements indicate consistently positive cash flow from operations. This cash supported key investments in machinery, enabled asset growth, and helped reduce debt. By generating cash internally, North Star showed a strong capacity to fund growth without heavy reliance on external financing. Our comparative analysis of North Star's historical financial ratios offers further insight into the company's performance. The analysis includes key ratios for profitability, liquidity, and leverage from 2020 to 2024. These ratios were reviewed over time to assess the company's internal performance trends. For example, the current ratio increased from 1.06 in 2022 to 1.67 in 2024, indicating improved liquidity. Similarly, profitability metrics like the operating profit margin rose from 0.92% to 4.22% in 2024, reflecting strong cost management and operational efficiency. The financial data analyzed includes financial fiscal year statements from 2020 to 2024, but the statements of 2024, however, are draft unaudited statements. In conclusion, the North Star casting companies Historical financial performance and comparative ratio analysis reveal a company that has effectively managed growth, controlled costs, and strengthened its financial stability. The comprehensive adjustments to accounting policies ensured consistency in industry comparisons, providing an accurate benchmark against peers. Nostar's improved financial ratios and positive trends in profitability and liquidity underscore its potential for sustained growth and stability, making it well positioned to support its employee stock ownership plan. Now Mirza will continue on to the valuation part.
So, in valuing the North Star Casting Company, we considered three primary approaches: the income approach, the market approach, and the asset based approach. In terms of the income approach, we chose the discounted cash flow DCF method because it captures North Star's projected cash flows, which are essential for understanding long term earnings. We did not use the capitalized earnings method as it lacks the flexibility of DCF for modeling specific growth rates, which are important for North Star's future projections. Secondly, in terms of the market approach, the guideline transaction method was selected since it uses private company transactions, which align with North Star's status as a privately held entity. The guideline public company method was not chosen, as public companies often have different financial structures and may not accurately represent North Star's market position. And finally, in terms of the asset based approach, we selected the net asset value method because North Star is an asset heavy company and NAV accurately reflects the fair market value of its machinery and equipment currently installed. The excess earnings method was not used as it could overlap with the DCF by adding an earnings component, which we wanted to avoid. Finally, we will apply a weighted approach, balancing these methods to reflect North Star's income, market, and asset perspectives for a complete and fair ESOP valuation. So, in terms of the DCF valuation overview, we calculate the free cash flow projections, which were developed by estimating future operating cash flows. These projections considered revenue growth, operating expenses, taxes, capex, and changes in the working capital. Starting from the year zero, where FCF is negative, we see initial outflows likely related to the investments. However, from year one onwards, FCF becomes positive, reflecting expected cash inflows as the company grows. And by the end of year five, FCF reaches $3.51 million. So these FCF projections are in line with the company's operational strategy and investment plans, allowing us to capture the company's growth potential over the forecasted period. Talking about the terminal growth rate, we applied a 3% terminal growth rate. This rate is chosen as a conservative estimate, close to long term inflation and economic growth, which ensures we are not overestimating the company's perpetual growth. The terminal value, which represents the company's value beyond the forecasted period, is an important component in DCF as it captures the majority of the value due to compounding effects. In this case, the TV is projected to be around $59.64 million. And finally, to determine the present value of each year's FCF, we discounted each cash flow back to its present value using our WACC of 9.08%, which I will further discuss in detail onto the next slide. By summing these discounted FCFs, we arrive at an enterprise value of $48.815 million. So, talking about how we came up with the WACC calculation and assumptions. Firstly, the cost of equity was calculated using the capital asset pricing model, which helps us determine the expected return required by the equity investors. So for the CAPM, we have used a risk-free rate of 4.18% based on the 10-year US Treasury yield. This rate is a standard benchmark representing a secure investment with no default risk. The beta of 1.126 was calculated as a weighted average of industry betas. North Star mainly operates across industries like automotive, medical devices, HVAC, defense, and industrial manufacturing. So we calculated a weighted beta to reflect the risk associated with each industry based on its revenue contribution. And finally, the market risk premium was set at 5%, which is based on the current market estimates, reflecting the additional return investors expect for holding equities over risk free assets. And combining these inputs, we calculated the cost of equity to be around 9.8%. Talking about the cost of debt, we looked at the historical interest rates paid on long-term debt. By taking the average cost from previous years, we calculated the cost of debt to be around 3.97%. And since these interest expenses are tax deductible, we adjusted this rate by the corporate tax rate of 21% to reflect the after-tax cost of debt. So the WACC calculation incorporates both the equity and the debt, weighted by the proportion in the company's capital structure. In our calculation, equity is valued at $606.5 million, while debt is around $75.223 million. Combined, the total value is around $681.7 million. Using these weights, the final WACC is calculated as 9.08%, which serves as a discount rate for our DCF analysis. Moreover, projected total debt for 2029, we used an average debt to EBITDA ratio of 8.3 calculated from the historical values. And with the projected EBITDA of 9.06 million for 2029, we estimated the total debt by multiplying this EBITDA, the debt to EBITDA ratio, resulting in a projected debt of $75.23 million. Now I will pass on to Jamin to talk about the other two valuation methods.
So I will talk about the market approach. So we have first of all selected these companies based on their operating segment and geographic segment and similar company profiles. Shiloh Industries and Metal Flow are public companies. Great Lakes and Southern Die Corp are private companies, and we have look after their total enterprise value and EBITDA multiple, and we have taken the median values for from these comparable companies, and we have arrived at the TEV over EBITDA multiple is 8.1, and TEV over LTM revenue multiple is 0.5. Moving over to the next slide, I will talk about the M&A transaction in this place. So the industry transactions in this space are particularly the Arconic Corporation, Alcoa Warwick, and Noranda Aluminum Holding Corporation. So these industries were in the die machinery industries, and these represent our similar markets. So we have taken basis for our valuation. So based on the publicly available data for the Shiloh Industries and the Metal Flow Corporation, the publicly available company Tenneco was acquired by Apollo Global Management, and the TEV over EBITDA ratio was 5.1 for that, and the TEV over LTM ratio was 4.4 for that. So we have taken this as our comparable transaction, and we have considered in our valuation. So from this, we have arrived at the enterprise value of the 35.365 million, and we have given the weightage of EBITDA to the 70% and TV over revenue to the 30%, because as the market approach is based on the profitability, so market gives more price to the profitability. So EBITDA approach was given more weightage, and revenue approach was given the less weightage. Uh, so based on the enterprise value, we have come over the equity value, which comes around the 28 million. And based on the current shares outstanding, the share price was around $65 point cents for the North Star. Now talking about the asset approach, what we have done here is like we have done the net tangible assets, basically deducting total current assets minus total liabilities, and we have after that we have normalized the EBIT and required return on equity. And what we have done here is like we have taken the 5-year average EBIT and smoothen it out, and 5-year average return on equity, and we have calculated the excess earnings, which comes around 5,77,000. Uh, we have used the build-up method for the capitalization rate. So for that, we have selected the risk-free rate 4.25% because it's the current yield on the 20-year treasury bonds. We have selected the industry risk premium for to be 3% because it is arrived by the deduction of the multiplying industry beta to the market risk premium. And we have taken the industry beta from the NYU Stern website of the machinery industries, and we have come up with the company specific risk for the 3.5% based on the size, operational and strategic risk it brought to the company. As Northstar has is small in size with $45 million revenues, and they have very highly concentrated customers. Over top 10 customers represent 63.5% of revenue. So we have considered these factors in the company specific risk. For the growth factor, we are projecting the North Star at the similar level of the long-term GDP growth rate, as industry is aligned with the GDP expansion. So from this, we have arrived at the 13.75% of the final capitalization rate, which will be applying on the excess earnings to arrive at the value. So based on net asset value, our total value of the North Star was around 13.2 million. And based on share outstanding, the share price was around $30.45. So we have adjusted the valuation with marketably discount and the control premium. So we have given the 20% marketably discount based on limited size, ESOP ownership, and customer concentration, and limited transferability in the private markets. And we have taken these details from the FactSet merger stats for the 2022, and it was taken for the lower quartile of that data. And similarly, for the control premium, we have adjusted to control premium to 25% because of their strategic value in magnesium casting specialization. They have over 150 machine in that. They have budget over EBITDA of 15.6%, and they have very strong market position in particularly in the East Coast, and they have very aligned in industry acquisition premiums with the control premium. And this data was also selected from the source of the FactSet merger stat. So based on the all three approaches, our total value for the North Star was around $42 million. And we have given the most weighted to the DCF approach, which was around 60%, based on the fact that they considered the growth factor and the operating characteristics of the company. And that bring in the they consider the strategic value also. And uh, it basically replicate the cash flows of the North Star. So that's why DCF was given the more weightage. We have given 30% weightage to the market approach based on the PV or EBITDA because it brings in the market perspective and the market view about the North Star. And we have given the less weightage to the asset valuation because it has limitation that it does not carry out the strategic value. It does not consider the strategic value in the future growth prospects of the company. That's why we have given the less weightage to the asset value methods. So based on this, we have arrived at the $42 million of the valuation for the North Star. Thank you.
As the advisor for responsible for this business valuation, we declare that we hold no current or future interest in business being valued and have remained entirely impartial throughout this engagement. This report is fully complies with ASA business valuation standard, effective as of the issuance date. We confirm that no individual other than appraisal team member have contributed significant professionally input into this valuation. To the best of our knowledge and belief, all statements in this report are accurate and truthful. Our compensation for this assignment is not contingent on any predetermined values, outcome, or events that might favor the client.
Stakeholders, thank you for your time and your consideration in our submission for this year's private business valuation competition.